So how does this new tax law impact business owners and investors?
President Trump's tax and spending cuts bill passed a key House hurdle. This comes after a GOP deal broke a budget committee deadlock.
Well, I've been a CPA for 45 years dealing solely with entrepreneurs and investors, and I've looked through this bill in great detail as it stands right now. And there are some really good things for businesses. First of all, it retains the 21% corporate tax rate. Well, you think, well, I'm a small business. I'm not organized as a corporation. Maybe now is the time to think about maybe you should be organized as a corporation, because there are some tax benefits for corporations, 21% tax bracket, that you don't get if you're a pass-through. However, there's something really good in this new tax bill for pass-through entities. Pass-through entity is like a sole proprietorship, a partnership, or an S corporation. LLC's tax is one of those. Pass-through entities are really important to small business. And the reason the pass-through entities are so important is because most small business owners, they take their money out of the business. They don't leave it in the business. You want to be a C corporation if you leave a lot of money in the business. Of course, remember, it's 21% in the business, but when you take it out, you pay another dividend tax. That's actually a tax change I would like to see, where you're not taxed on dividends, or the corporation gets a deduction for dividends. One of those two, they really ought to consider putting in a tax bill sometime soon. That would really help the business community. But for now, we get a double tax when we're in a C corporation. So it only works if you're going to leave a lot of money and build up that corporation and then sell the corporation later. However, let's say you're a pass-through. So you're an S corporation or a partnership, or heaven forbid, a sole proprietor. Please don't be a sole proprietorship. Please don't do that. That's a Schedule C. You're ripe for audit. Please don't do that. Okay. So you want to be, if you have a regular operating business, you're going to want to be an S corporation or a C corporation. S corporation if you take a lot of money out of your business, or C corporation if you leave a lot of money in your business. It's that simple. Now, in an S corporation, under this new bill, not only do we get the 20% pass-through deduction made permanent, which means the top rate with a pass-through deduction it's a 20%, means you're really only being taxed at 29.6% instead of that 37% rate. But under this bill, the proposal is to increase that rate from 20% to 23%. So it's an even better tax benefit for small business owners who want to operate as an S corporation. Now, one of the negatives is these high tax states. One of the things they're looking at is, do they want to eliminate the state and local tax deduction that pass-through entities get? And they are looking at that really hard. So let's watch that very carefully, because that could be a serious offset to that 23% tax deduction that you're getting. Then all of a sudden you're paying taxes on top of taxes because you don't get your pass-through tax deduction. That would be bad. All right, so the 23%, that's a really good thing. So that means that, first of all, please, please, please don't be a Schedule C. Let's be an S corporation. Then when you're an S corporation, you have to figure out, how much salary am I going to pay? Because remember that salary is subject to Social Security taxes. Distributions from an S corporation are not subject to Social Security tax. So the inclination is, well, let's make my salary as low as possible. However, remember the pass-through entity deduction requires that you pay salary. So what you want to do is you want to sit down with your CPA and actually figure out how to maximize your pass-through entity deduction while minimizing the Social Security taxes you pay. So it's always, like I say, you always have to run the numbers. If you want to know what's going on, you need to run the numbers, because it may be that you need to change your facts. As I always like to say, change your facts, change your tax. So if you want to change your tax, you have to modify and be careful about what your salary is coming out of your S corporation. Again, you don't want it to be zero, because then the IRS could come in and assert, hey, we're going to treat all your distributions as salary because you treated none of it. And it seems to me like, you're just doing all the work yourself. Therefore, 100% should be treated as salary. So you really put yourself at a high risk if you take 100% as distributions. So instead, figure out how to make the most of both that 23% deduction and minimizing your Social Security taxes. So that's something that we want to watch out in the new bill. Now, I'd mentioned in another video that we have change in the solar tax credit and the automobile tax credit. Here's where you have to look at the effective date. Now, that's not a term that's used a lot in your everyday life. What's the effective date of this bill? Well, under the bill as it was originally proposed, the effective date for the $7,500 electric car credit is the end of this year. It's the end of 2025. So that means you want to buy your electric car now. Okay, don't wait. until 2026. However, if they change that effective date, they could change it to today. So the sooner you take action, if you're planning on buying an electric car sometime this year, you might want to consider doing it now. All right. They're also talking about eliminating that tax credit for leases. Okay. So if you want to lease an electric car, you want to do that right away, but you might want to actually consider buying that electric car because that $7,500 tax credit may not apply to leases in the future. Second of all, let's say you're in a sunshine state like I am in Arizona, and you are thinking, well, let's put solar on our house, or better yet, what I love, let's put solar on our office building that we own, or let's put solar on our rental properties, okay? Because the tax credit is 30%. It's 30% of the cost, and because of the bonus depreciation coming back, remember, your solar panels are equipment if they're on your business property. So either on a rental property or on your business building, not on your personal residence. This doesn't happen in a personal residence. But let's say that you're putting it on your commercial building or on your rental property. Well, now you get a 30% tax credit, but you also get bonus depreciation. And the bonus depreciation provisions, the effective date, there's that term again, the effective date is the beginning of 2025, whereas it looks like the effective date for the solar is going to be after 2025. So they're going to take it down after 2025. That means that if you put it up this year, you might get both a deduction of 85%. It's not the whole 100%, but 85% of the cost. So if you put $100,000 of solar, you're getting an $85,000 deduction and a $30,000 credit. That means the government's paying for roughly 2/3 of the cost of your solar installation. And if it's offsetting your electricity costs, which of course in Arizona, we have high air conditioning costs in the summer, you put in the battery, you put on the solar, government to pay for 2/3 of it, but you get all the benefit. So that is very, very cool opportunity, but that's something you need to act now. You cannot wait to act on that because it takes a long time. You've got regulations at your city or your county, sometimes at your state, what you can do with solar, maybe even your homeowners association, what you can do. So you need to get started right now. If you're thinking about putting on solar panels, this is the time to do that. There are some other renewables that are similar to that. You know, you might be thinking about putting in some charging stations, right? It's charging equipment somewhere. A few years back, ATMs were the big rage, right? They were going in all over the place and they were all independently owned for the most part, except for the ones at the bank, right? They're independently owned ATMs. And then there were the cell towers, right? That was a big thing that everybody was going into. Well, today it might be the charging station, and the charging station might be something that you want to get in right now because that credit's going to go away. So if you're going to do one of these things, solar panels, charging station, electric car, you probably want to do it right now. There are some other things. The effective date might be after this year. Okay. Typically, if it's after this year, it's because it's going against the taxpayer. And if it's good for the taxpayer, it's going in earlier. Now, what we don't know yet, we won't know what the effective date is for the tips. My guess is it'll be 2026 being tax deductible, or the overtime being tax deductible, or the car interest being deductible. Those things may wait until 2026, but who knows? So watch that really carefully. There are things you want to do. Now, the most important thing as a business owner and an investor, you want to pay such close attention because your taxes are your wages, are your single biggest expense, and they will put the biggest drag on building your wealth and how much money you have available to you to put back into your business to grow your business. So first of all, please make sure you're not a Schedule C. Do not do that under any circumstance. I used to think it was okay if you weren't making very much money, but what I've found is that the IRS loves to audit Schedule C. So if you don't want an IRS audit, don't do a Schedule C. Second of all, the tax benefits, remember a Schedule C, you pay a self-employment tax or Social Security taxes on 100% of your income. If you're an S corporation, it's only on your salary. So you want to be an S corporation or a C corporation, depends on, am I keeping money in the business or am I going to take all the money out of the business? Now, if you are keeping your money in the business, there's another great tax strategy that we probably ought to do a whole video on called Section 1202, which basically allows you to sell your business tax-free. Yeah, you heard that. If you're a C corporation, you can't do this as an S corporation. If you're a C corporation, you can potentially sell your business tax-free after 5 years if you do follow all the rules for Section 1202. Now, if your accountant hasn't been talking to you about this stuff, you might want to get a second opinion. Talk to an accountant, that's a referral, talk to an accountant that you trust, talk to somebody you know. And when you do that, then maybe get a feel. Are they really doing things in my best interest, or are they just trying to protect themselves? This is why I wrote the book, Tax-Free Wealth. I wrote that book so that you could know enough to know whether your accountant was actually doing the things that they should be doing, which in my mind, your CPA, your accountant should be your primary advisor when it comes to your business. They should be your primary business advisor. And if they're not, again, maybe think twice, maybe get a second opinion, and maybe it's time to scale up and get a better accountant. If you want to see the full breakdown on the $4 trillion tax bill, watch this video next.